Soft Currency Economics by Warren Mosler. Controlling the Fed funds rate. The supply of reserves consists of three parts: vault currency, reserves supplied through Fed open market transactions, and loans from the Fed's discount window. To the extent the Fed leaves the banking system short of reserves through open market operations, banks short of reserves try to borrow from each other and bid up the Fed funds rate. As the spread between the Fed funds rate and the discount rate widens, more banks will borrow from the discount window. Borrowing from the discount window carries some administrative costs as well as a stigma of financial weakness. Nevertheless, as the funds rate rises higher and higher above the discount rate, more banks will go to the window. Banks are, after all, profit-making businesses, and the financial incentives to borrow from the window increase as the spread between the funds rate and the discount rate widens. Figure 5a shows that when interest rates on Fed funds rise above the discount rate, depository institutions borrow from the Fed. In other words, the Fed supplies the needed resources to the banking system by purchasing securities in the open market or lending at the discount window. By adjusting the composition of the reserves between borrowed and non-borrowed, the Fed sets the spread between the Fed funds and the discount rate. The Fed uses open market operations to adjust reserve balances so as to keep the banking system in a net borrowed position. To reduce the spread between the Fed funds rate and the discount rate, the Fed provides more unborrowed reserves through open market purchases. To increase the spread the Fed provides fewer unborrowed reserves, which requires banks to bid up the price of Fed funds and borrow more heavily from the discount window. The Fed funds rate is closely watched by the trading desk of the Federal Reserve Bank of New York as the indicator of the reserve position of the banking system. Every depository institution with a reserve requirement ends its reporting period and must come up with its required reserves, an average for the period, by the close of business on every other Wednesday. A perceived surplus sends the funds rate plummeting downward. An expected shortage sends the rate shooting upward. Perceptions sometimes shift rapidly on Wednesday afternoon, the last day of the 14-day reserve accounting period. Figure 5b shows a case in which the supply of reserves exceeds the demand for reserves. Depository institutions have more non-borrowed reserves than they need, hence the funds rate would fall sharply. In April 1979, for example, the rate fell from double-digit levels to 2% in one day. Open market operations are carried out by the Federal Reserve Bank of New York under the direction of the Federal Open Market Committee, FOMC. The voting members of the FOMC are the 7 members of the Board of Governors of the Federal Reserve System, the President of the Federal Reserve Bank of New York, and 4 of the presidents from the other 11 Federal Reserve Banks, who serve on the FOMC on a rotational basis. The Federal Open Market Committee meet in Washington, D.C. about every 6 weeks to assess the current economic outlook. The FOMC votes on intermediate policy objectives and issues a directive to the trading desk manager of open market operations in the New York Federal Reserve Bank. The directive stipulates the target Fed funds rate.